Good day, everyone. Today I'll be discussing the major changes around the superannuation rules and how that might impact your clients come 1st July 2017. The changes to super law are perhaps the biggest changes since the simpler super rules in 2007. So I'm hoping there will be much to take from this webinar. Now, before we begin, for those of you who are unfamiliar with the GoToWebinar app, I'll brief you on some of the features very quickly. The orange arrow on the activity panel to your left allows you to expand or contract the screen. And for most of you on the audio panel, you'll be switched on to the computer audio mode. For those of you who can't hear me, you may prefer a dial-up connection. Click onto the phone call icon and you'll find the dial-up number, the access code, and the PIN on the audio panel. Kindly follow the prompts on the telephone after the dial-in occurs. Further, the handout section is where you can download the handouts by clicking on the red marked area on the screen. Also, you can type your questions in the panel below and click on the send button to send in your questions. We will answer them later at the end of the discussion. And finally, a small brief about myself before we begin. My name is Agni Chowdhury. I'm a CPA SMSF Specialist Advisor with over 7 years experience in SMSFs, and I also hold a Master of Accounting from Macquarie University. I believe I have in-depth specialist knowledge in SMSFs, having administered, advised, or having closely worked with over 1,000 funds. Finally, I'm very deeply passionate about this area and the structuring opportunities that exist for my clients. My email and contact details are as displayed, and should you have any questions, please contact me. So now let's dive straight into the topic. The new rules will significantly impact members looking to build their super for retirement. The context behind these reforms seem to be fairness and sustainability. The correct treatment of concessional superannuation contributions means high-income earners disproportionately benefit from the superannuation tax concessions. This is in part because they have the capacity to make greater superannuation contributions and also benefit more from these contributions being included in the income of the fund and concessionally taxed rather than in their assessable incomes. As high-income earners will generally save for their retirement, both within and outside the superannuation system, these concessions were felt to have been poorly targeted. Reducing the annual cap on concession contributions will require high-income individuals to hold a large portion of their savings outside the concessionally taxed superannuation environment. This therefore reduces their ability to utilize the superannuation system as a tax-advantaged savings vehicle. The summary of the main context for these rules are a better targeting of tax concessions, which again will improve the fairness and sustainability of the superannuation system. Secondly, the flexibility measures, like some of the new provisions, like catch-up rules, which have been recently introduced, will enable more individuals to save for their retirement, providing individuals, especially those individuals with low incomes or with broken work patterns, with more ways to save for their retirement, will enable them to be more likely to have higher retirement incomes. And finally, the integrity measures will also ensure that superannuation is not primarily used for tax minimization purposes. It will also increase alignment with the objective of superannuation and also perhaps streamline processes across the superannuation system. The bill further talks about superannuation tax concessions, which are currently poorly targeted. A significant proportion go to people who will save for their retirement, regardless of the concessions, and who will never depend on the age pension. Some of the things that I will be discussing in this webinar are the new concessional and non-concessional contribution caps, the new concessional catch-up provisions, which are again a very interesting addition to these rules, the total super balance with new limits on non-concessional and some other contributions, the transitional non-concessional rules, removal of the 10% test, contributions to constitutionally protected funds and other funds such as defined benefit funds, the fund capped contributions, and finally, the key issues, actions, and strategies pre 30th June 2017. Let's begin with the first. The new concessional contribution caps. For financial year ended 30 June 2018, the cap amount is $25,000, down from the 35,000 and 30,000 caps that exist for the current financial year. The cap is indexed and increases in increments of $2,500 in line with the average weekly ordinary time earnings, or AWOTE. Moreover, there are certain changes to the Division 293 income tax threshold for high income earners, which applies to an individual obviously with in an income year if the total of the individual's combined income for surcharge purposes and concessionally tax contributions exceeds 250,000, which is down from the current $300,000. The new non-concessional contribution caps. The annual non-concessional contribution cap is 4 times the annual concessional contribution cap. So for financial year 2017-18, this is 100,000, which is 4 times the concessional contribution cap, down from the 6 times of NCC cap, which applies for the current financial year. This does not include any increases in the concessional contributions cap due to the carry forward of unused concessional contributions cap, which we'll cover a bit later in the webinar. The annual non-concessional contribution cap is indexed as the concessional contribution cap is indexed. The non-concessional contribution cap is indexed in the 2,500 increments in line with the AWOTE. For the sake of clarification, now your super balance will now effectively determine the non-concession contributions you can make from 2017-18. An individual must have a total superannuation balance of less than the general transfer balance cap as on 30th June of the previous financial year to be eligible for the non-concessional contribution cap in the relevant financial year. A very important piece of legislation. Again, an individual can only make a non-concessional contribution if their total super balance is less than the general transfer balance cap. For the sake of clarification, the general transfer balance cap for the 2017-18 financial year is 1.6 million and is indexed in 100,000 increments in line with the consumer price index. Now, it is not within the scope of this webinar to discuss the transfer balance cap. Very complex and a lot of areas that need a discussion, and we will discuss this in a later webinars, so keep you updated on that. The new concessional catch-up provisions. Now, one of the most significant provisions that have been introduced in the super reforms is the catch-up provisions. The flexibility measures of the super reforms package envisage that more individuals save for their retirement. It will enhance the flexibility for those individuals who take time out of work or work part-time, which is by and large women, or may have lumpy income, for example, small business operators, by allowing them to make catch-up concessional contributions. Annual concessional contributions cap can limit the ability of people with interrupted work patterns or irregular income to accumulate superannuation balances commensurate with those with more regular or steady income. Allowing people to carry forward their unused concessional contributions cap for a period of up to 5 financial years will provide them with the opportunity to catch up if they have the capacity and should they choose to do so. The main points of these regulations are: the first year of application is 2019-20. This means that the first year from which you can carry forward is 2018-19. Secondly, the concessional contributions for the year exceed the concession contribution cap for that particular year, and the total superannuation balance is less than 500,000 just before the start of the financial year. Now, this is very important. Total super balance is less than 500,000 just before the start of the financial year. And there existed unapplied or unused concessional contributions cap amounts for one or more of the previous 5 years. And finally, after 5 years, these credits will expire. The task will be then to access first if the super balance cap is less than 500,000. If it is, then the cycle may continue. We will explain this with the help of an example. Here, Anne, who's 40 years old and working, has a superannuation balance in her super as on as on 1st July 2016. I'm sorry. Yeah, find below the concessional contributions that she makes for the remainder of these years. So 2016-17 and 17-18, she makes 10,000 contributions, and the carry forward amount is irrelevant because the first year of operation of these rules are 2018-19. So from the 2018-19 year, when her actual contribution was $10,000, she has a carry forward amount of $15,000, which is the annual cap 25,000 less the actual contribution. The maximum contributions which she can therefore make in the next year is $40,000, which is 25,000 cap of that particular year, plus the carry forward amount of $15,000. In the 2019-20 financial year, and assuming no indexation, there is an actual contribution of $10,000, which means 15,000 carry forward balance for that particular year. So the total maximum contribution she can make for the 1920 year is $55,000. Now this is the $25,000 cap for that particular year, plus the $15,000 and $15,000, which are the carry forward amounts of the previous year and the current year. For the 2020-21 year, her actual contribution is again $15,000. So she has a carry forward amount of $10,000, and the maximum contributions therefore are $65,000, which is the $25,000 plus the $10,000 of the current year and the $30,000 from the previous two financial years. For the 21-22 year, the contribution again $15,000, carry forward amount of $10,000, and the maximum contributions for the next year is $75,000. Now I'll leave that. I'll leave you to work the $75,000 out. Yes. So when we move to the 2023-24 years. Now that is the last year of application for the carry forward $75,000, which is again your 25 plus the $50,000 of carry forward balance. At the end of the year, the client will then have to work out his balance, and if it is below 500K, then the cycle may continue. So for the 2024-25 year, they will contribute, and then they will have a carry forward amount, and then they will determine the maximum contributions which can be made in the following year. Now, some new limits on non-concession and some other contributions. An individual is eligible to access the bring forward non-concessional contributions cap in a particular financial year if their non-concessional contributions for that financial year exceed their general non-concessional contributions cap. Secondly, their total superannuation balance, which is worked out on 30th June each year, is less than the general transfer balance cap, which is 1.6 million plus indexation. Thirdly, the difference between the general transfer balance cap and the total superannuation balance, that is the first year cap space, is greater than their general non-concessional contributions cap, which is $100,000. And they are under 65 years of age at any time in the financial year. Finally, a bring forward period is not currently in operation in respect of that financial year. Let's work this out with the help of an example. From 1st July 2017, which we've spoken of, if the first year space, that is the difference between the general transfer balance cap in the relevant financial year and the individual's total superannuation balance as on 30th June of the previous financial year, is greater than 2 times the general non-concessional contributions cap, or 200,000, or the super balance is less than 1.4 million. An individual's non-concessional contribution cap for the first year is 3 times their general non-concessional contributions cap, and their bring forward period is 3 years. In the 17-18 financial year, this would equal $300,000 or 3 times $100,000 with a 3-year bring forward period. However, if their first year space, again, the difference between the general transfer balance cap in the relevant financial year and the individual's total superannuation balance as at 30th June of the previous financial year is between 1 and 2 times the general non-concessional contributions cap, 100,000 and 200,000 obviously, then the bring forward cap is 2 times the general non-concessional contributions cap, and the bring forward period is 2 years. So that means someone with a total superannuation balance of 1.4 million to less than 1.5 million as on 30th June 2017 is able to access a 200,000 bring forward cap over a 2-year bring forward period. However, if the difference between the general transfer balance cap in the relevant financial year and the individual's total superannuation balance as at 30th June of the previous financial year is less than the general non-concessional contributions cap, which is 100,000, then the individual is not eligible to a bring forward cap, but is eligible for the general non-concessional contributions cap, 100,000 in 2017-18. An individual's total superannuation balance is determined, as we spoken on 30th June of the previous financial year. Finally, 1.6 million and above, obviously the non-concessional contributions is nil, so you cannot make any non-concessional contributions if your superannuation balance is 1.6 million or greater than 1.6 million. Those individuals who have triggered their bring forward rules in 2015-16 or the 2016-17 financial year are subject to some very interesting transitional arrangements. Where an individual's total superannuation balance is calculated as on 30th June 2016, the calculation of the individual's transfer balance is based on the sum of credits to their transfer balance account just after the start of 1st July 2017 less the sum of certain debits to their transfer balance, which is very much like a franking, a dividend franking credit account. You know, a similar analogy between the franking credit account and the transfer balance cap. Transitional rules now apply to individuals who have activated the bring forward rule in the 2015-16 or the 16-17 financial years to ensure that they do not retain the benefit of existing higher caps for the remainder of their bring forward period. An individual must have been under obviously the transitional provisions. Now, a very important provision is that it does not affect an individual's non-concessional contributions cap for any financial year that ended before the 1st of July 2017. An individual must have been obviously under 65 years for at least a day in the year to trigger the bring forward rule. Moreover, an individual must have had a total superannuation balance of less than 1.5 million as on 30th June 2017 to be eligible to access their bring forward caps in the 17-18 financial year. Individuals with a total superannuation balance that equals or exceeds the general transfer balance cap 1.6 million, we've spoken on this before, will have a non-concessional contribution cap of nil in the relevant financial year of their transitional bring forward period due to the application of the standard rules which apply to non-concessional contributions cap for individuals with superannuation balances which are greater or equal to their general transfer balance caps. After a bring forward period was triggered in the 15-16 or 16-17 financial year end, the individual is subject to the general rules regarding bringing forward of their non-concessional contributions cap. Let's look at an example to understand this well. In this example, we assume that the bring forward period has been triggered in the 15-16 financial year. When an individual triggered their bring forward period in the 15-16 financial year, their non-concessional contributions cap for the first 2015-16 and a second to 16-17 years are set by the rules that apply to those financial years, which are 180,000 each. However, the cap for the third year, which is the 2017-18 year, will be set by the transitional rules put in place by this schedule. The third year cap for 2017-18 is determined under the standard calculation for third year caps, but applied as if the first year cap had been $460,000 as shown in the example. These transitional rules modify the calculation of the second year cap for the purposes of ensuring that the correct third year cap. This is necessary because the third year cap is based on the unused portion of caps from the prior years. However, this modification does not affect the actual cap that applies to the individuals in the 15-16 or the 16-17 financial years. The first year cap of 460,000 represents the 180,000 for each of the first and the second year, which is equal to $380,000. Sorry, $360,000, and $100,000 for the third year, which is equal to the annual cap for the 2017-18 year. If the bring forward rule was triggered in the 16-17 financial year, then their non-concessional contributions for the first year is set by the rules that apply to that financial year. However, their cap for the second and third year are set by the transitional rules put in place by this schedule. The second and third year caps for the 2017-18 and 18-19 financial years are determined under the standard calculations for those caps, but applied as if the first year cap had been $380,000. The first year cap of $380,000 represents the 180 for the first year, equal to the annual cap for that 16-17 financial year, and 100,000 for each of the second and the third years, equal to the annual cap of the 17-18 and 18-19 financial years, assuming that the cap has not increased in 18-19 due to indexation. We will look at a quick poll question to understand these rules a little better. Here, John is 63 years on 5th July 2015, say, works in his son's pizza shop for 8 hours in a week and has contributed to the below non-concessional contributions amount to his SMSF. In the 14-15 financial year, he's contributed $170,000. In the 15-16 financial year, he's contributed $150,000. His balance is 1.8 million on 30th June 2016. Further, he receives a 1 million inheritance from his father's estate. Now, the question for you is, what is the maximum amount he can contribute to the non-concessional contribution as non-concessional contributions in 2016-17 to his SMSF without breaching the cap amount? Please type your questions in the question panel below. All right. Some interesting answers. Oh, we're going all over the place. Okay. All right. Yes, I think a majority of you have got that right. The answer is D, actually, 540,000. Now let's understand why. Some relevant information. Firstly, 8 hours in a week. So he works less than 10 hours in the week. Gainful employment. Now, because he is under the age of 65, so that is irrelevant. He does not breach the cap for the either for the 2014-15 or 15-16 financial years. So going to the 16-17 financial year, he can effectively make $540,000. Remember, we'd spoken about this earlier, that the transitional provisions, they ensure that these rules do not affect anything that happens prior to the 1st of July 2017. So, so this is his best chance to maximize his bring forward cap for 2016-17. And also because he has not breached the cap in the previous 2 financial years. All right, let's move on to another question. Same question, but with a few twists on it. Here, John, who is 63 years, again on 5th July, works in his son's pizza shop now, this time for 16 hours in a week, 2 days in a week. His balance is 1.8 million as on 30th June 2016. Again, he receives a 1 million inheritance from his father's estate. John contributes 500,000 non-concessional contributions on the 1st of July or 1st of August 2016 after his 65th birthday. What is the maximum contribution that he can make in the 2017-18 year? Assume there is no income or loss in the fund without breaching the cap limits. Questions again on the your answers on the question panel, please. All right. Okay, again, many different answers here, but the correct answer this time is A, which is nil. Obviously, because John has exceeded his transfer balance cap of 1.6 million, and therefore the transitional bring forward rules did not apply here. Now, moving on to the next slide. Some other important changes in the current legislation is the removal of the 10% test for self-employed from 1st July 2017. So from 1st July 2017, a self-employed can claim a deduction for super contributions irrespective of whether they earn 10% or greater of their income from salaries and wages. If they are above 65 years of age again and less than 74, they will still need to meet the works test. Further contributions cannot be made to certain defined benefit and constitutionally protected funds. Contributions to concession protected funds now. Contributions and amounts in respect of constitutionally protected funds and some unfunded defined benefit schemes will now count towards an individual's non-concessional contributions cap. Previously, these amounts did not count against a member's concession contributions cap. These amendments ensure the concessional contributions included as a result of these amendments are not treated as excess concessional contributions and subject to tax. What this means is that constitutionally protected funds and unfunded defined benefit schemes are not taxed as concessional contributions, but are merely aggregated for the purposes of determining the cap. Moving on to fund cap contributions. Now there is a limit on the amount you can accept in a single fund cap contribution. A fund cap contribution is generally the maximum amount that your fund can accept. If you receive a fund cap contribution from your member, which is more than the fund cap contribution amount limit, you must return the excess amount within 30 days. The fund cap sub-regulation applies per contribution and not on the total members' contributions to your fund. So for instance, if in 16-17, Peter, who is 60 years, makes two personal contributions of $100,000 each. Individually, neither one of Peter's contribution is greater than his fund cap contribution amount for the financial year. Therefore, his fund cannot return any part of the contributions to him. It must report 800,000 as Peter's personal contributions for that year. Now, the fund cap contribution limits for the 16-17 year are 540,000 for members under 64 years and 180,000 for members over the age of 65 years. For the 17-18 years, it's 300,000 for members under 64 years and 100,000 for members above 65 years. There are some exclusions from these fund cap contribution limits, and those are personal super contribution deductions, any amounts received as a result of personal injury. Then again, if it qualifies for the super CGT cap limit for small business owners looking to put their sale of business capital gains into their super. Directed termination payments and Finally, government contributions such as coal contributions, low-income super contributions, or the low-income superannuation tax offset. Some key issues, actions, and strategies. Pre-30th June 2017, we virtually at the end of the year, and we must plan before the year is out. Uh, so what are some of the things we can do? Firstly, we can maximize the non-concession contributions for members who have superannuation balances above 1.6 million limits. Now, if we withdraw pensions up to 540,000 for each member and we contribute it back to our SMSF, this will obviously increase the tax-free component of these members, and post 1st July 2017 result in a greater share of the earnings being tax-free in pension. So again, you have a member who has whatever, more than 2 million or 2.5 million. You could withdraw, and there are two members in the fund, husband and wife. You could perhaps withdraw a million 80, and we contributed back to the fund, maybe $500,000 each to husband and wife, and increasing the tax-free components, and also some part of the components which are and sharing the transfer balance gap effectively between the spouses. The second point is to set up another SMSF for members who have more than 1.6 million due to segregation of assets rules. Now, post 1st July 2017, a member's balances above the 1.6 mil cap will need to be commuted back to accumulation. This will result in such funds to be treated as non-segregated funds, for which an actuarial certificate will be required unless the excess is withdrawn as lump sum or commuted to accumulation account in another super fund. And finally, we need to watch out for concession contributions made in June 2017 that will be allocated in July as part of contribution reserving strategy. This is because for the 2017-18 financial year, the contribution cap limit is 25,000 and not 30 or $35,000. Finally, I thought I'll take this opportunity to introduce two new websites that have been developed by deed.com. The first one is smsfdeed.com.au, and it's live, and the value proposition in this website is that you can now apply for a corporate trustee, an SMSF, and an AB and TFN, all as part of the single application process. So no duplication of data. Imagine the amount of time you can save by not having to go through the ATO ABN application. The cost is $125 for the SMSF and an extra $40 for the corporate trustee plus asset fees. The ABN registration is free of charge. Now this is a terrific website, and the beauty of it all is that it is fully integrated with ASIC and the ATO. The second website is www.ecpi.com.au. The value proposition again for this website is the price, which can be as low as $55. Now imagine that. But obviously it depends on the number of certificates that you buy as a pack from the website. This is obviously going to be a significant savings in terms of what you spend for your actual certificate. The other great feature about this website is the design aspect. Now, if you've used Trustdeed so far, I urge you to try this website. It'll save you half the time and also cost you half as much.
Now here commutations, pension comments means are very intelligently picked up by the system and you only have to enter them once. So here no more data mismatches, error messages coming up when you're trying to move in, because the, the entire application is way too long. Now we've also combined the pension accounts and accumulations. So again, the form, we've greatly reduced the form and it is only half a page long here. If you want to discuss getting to use these websites, please contact me. My details are part of the handouts. Again, now this brings us to the end of our discussion. So I hope this webinar was insightful and I've been able to shed some crucial light on some of the important super changes. With more to come and more technical webinars, I hope I will see you all in a fortnight. Now, many thanks for attending and we will get to your questions shortly. Thank you.